Have you ever wondered why financial freedom looks so simple on paper, yet in real life, it always takes longer than expected? Many people calculate a freedom number, save diligently, and invest consistently, assuming that they will reach their goals in a few years. But then life intervenes. Taxes increase, living costs rise, family responsibilities appear, markets fluctuate, and unexpected events change the trajectory. Financial freedom isn't just about earning more or investing. It's about building resilience, flexibility, and long-term stability. In this video, we'll break down the hidden reasons that extend the timeline for achieving financial freedom and show you how to navigate these delays with patience, discipline, and a realistic mindset. 1. Most people underestimate their real freedom number. One of the main reasons financial freedom takes longer than expected is that people consistently underestimate the actual amount of money required to feel secure. Many calculate their freedom number based solely on current, observable expenses, rent, groceries, utility bills, and debt payments, without considering how life evolves over time. Future inflation, unexpected medical emergencies, lifestyle upgrades, and other unforeseen financial demands can dramatically increase the capital necessary to maintain a comfortable life. For example, the cost of healthcare often rises faster than standard inflation, and long-term care expenses for aging parents may not even appear in early projections. Similarly, the desire for better housing, education for children, or even travel and leisure can inflate your ideal lifestyle well beyond your initial calculations. A realistic freedom number should therefore account for all these factors, including essential living expenses, long-term inflation, healthcare costs, taxes, emergency reserves, and flexibility to accommodate lifestyle changes. By including a buffer for contingencies, you create a more accurate picture of what it truly takes to be financially independent. Ignoring these elements can create a false sense of progress. Mathematically, you might think you are on track, but in reality, your future self could feel insecure or underprepared. True financial freedom is not merely having enough money to quit working. It is having the confidence to sustain your lifestyle despite unforeseen events or market volatility. Proper planning for contingencies ensures that your freedom number reflects reality rather than an idealized spreadsheet projection. This approach allows for proactive decision-making, such as setting aside larger emergency funds, investing strategically in assets that outpace inflation, and preparing for future family responsibilities. By understanding the real scale of financial needs, you can create a roadmap that accommodates growth, mitigates risks, and ultimately accelerates your journey toward genuine independence, providing both security and peace of mind. 2. Taxes slow down your progress more than you think. A major hidden factor delaying financial freedom is the effect of taxes, which often erodes wealth silently over time. Many people assume that earning more directly accelerates their path to freedom, but higher income often comes with higher marginal tax rates. While gross income may rise quickly through promotions, bonuses, or side hustles, the net investable income, the money that can actually be saved or invested, grows much more slowly once taxes are considered. Capital gains, dividends, interest, and retirement account withdrawals are all subject to taxation, further reducing the compounding potential of investments. For example, an investment that earns $10,000 in capital gains may lose $1,500 to $3,000 in taxes, significantly slowing overall portfolio growth. Without proactive tax planning, even substantial earnings may fail to accelerate financial freedom. Strategies such as contributing to tax-advantaged retirement accounts like 401k, S or Roth IRAs, leveraging deductions for business expenses, and strategically placing high dividend or taxable investments in the most tax-efficient accounts can preserve wealth. High earners often focus on gross income and overlook after-tax wealth, which is a true driver of financial freedom. Additionally, tax-efficient investment strategies like long-term holding to reduce capital gains taxes or utilizing municipal bonds for tax-free interest can compound growth more effectively. Ultimately, the amount you keep and reinvest after taxes determines how quickly you achieve freedom, highlighting the importance of understanding and planning around taxation as a critical component of financial strategy. 3. Lifestyle inflation quietly moves the goalpost. Lifestyle inflation is another subtle but powerful reason why financial freedom is often delayed. When income increases, People tend to upgrade homes, purchase newer cars, plan more extravagant vacations, and enhance everyday living standards. These changes often feel deserved and rewarding after years of hard work, but they quietly shift the baseline for financial security. What was once considered a luxury gradually becomes a new normal, meaning that your freedom number, the amount of money required to feel financially independent, must rise to support this upgraded lifestyle. This phenomenon, known as hedonic adaptation, creates a moving target. Your expectations adjust upward as your income rises, which means the financial freedom you once aimed for may no longer feel sufficient. For instance, a person who initially calculated that $60,000 per year would allow them to live comfortably may find that with higher income, they desire a larger home, better schools for their children, or more frequent travel, effectively doubling the necessary financial cushion. The solution lies in intentional upgrading and disciplined financial planning. Rather than automatically increasing spending with each raise or bonus, allocate a significant portion of extra income into investments, retirement accounts, or high-yield savings. By consciously directing raises and windfalls into wealth-building assets, you counteract lifestyle inflation, allowing your net worth and investment portfolio to grow faster than your personal consumption. Small, deliberate decisions, like delaying car upgrades, limiting luxury purchases, or capping discretionary spending, compound over time, preserving capital and accelerating the path to true financial freedom. The key is balancing gratification with foresight, ensuring that enjoyment today does not compromise long-term security and independence. 4. Family responsibilities can change the entire timeline. Financial freedom is rarely an individual pursuit. Many people must support aging parents, adult children, or family emergencies. These obligations divert capital that could otherwise compound toward freedom, especially during high-earning years. Ignoring family responsibilities can create frustration, but acknowledging them allows proactive planning. This may include building larger emergency funds, setting clear boundaries, creating separate family funds, or obtaining insurance to manage obligations. The more realistic the plan includes family risk, the less likely you are to feel stalled by these inevitable financial demands. 5. Asset prices often rise faster than wages. Another hidden obstacle is asset inflation. Real estate, high-quality stocks, and other productive assets often increase in price faster than wages. People may save diligently, but as assets become more expensive, the purchasing power of saved capital diminishes. Waiting to buy the right asset at the right time can be costly because the window of opportunity may pass as prices climb. The answer is consistent investing and gradual accumulation. Start early, invest regularly, and diversify across asset classes to stay ahead of inflationary pressures. Small, consistent contributions build momentum and allow you to purchase valuable assets over time, even as prices rise. 6. Market returns are not smooth or predictable. Many projections assume a steady 7 to 8% annual return, but real markets fluctuate. Some years outperform, some years underperform, and sometimes portfolios experience steep downturns. This sequence of returns risk can dramatically delay financial freedom, especially if a major market drop occurs when your portfolio is large or when you are close to retirement. Planning for volatility is crucial. Diversify, maintain emergency cash, and adopt a long-term mindset. Expect fluctuations and avoid panic selling. Financial freedom takes longer not because compounding doesn't work, but because markets are unpredictable. 7. Side hustles take time before they truly scale. Side hustles can accelerate wealth, but rarely produce immediate results. Linear side hustles trade hours for income, limiting scalability. Scalable side hustles, like digital products, online businesses, or content creation, take months of testing, learning, and refinement. Many quit too early, expecting instant results. Financial freedom takes longer when the learning curve is underestimated. Start small, prove your concept, and double down on what works. Patience is critical to allow side hustles to compound and meaningfully impact wealth accumulation. 8. Financial freedom has stages. Financial freedom is a staircase, not a single leap. The journey includes dependency, self-sufficiency, stability, security, flexibility, financial independence, and finally, financial abundance. Progress occurs gradually, and each stage requires distinct habits, discipline, and decisions. Understanding these stages prevents discouragement and allows for realistic planning. Even small milestones, building an emergency fund, paying off debt, making the first investment, represent significant progress. Respecting the stages ensures you focus on achievable goals, reducing stress, and improving the likelihood of long-term success. So, there you have it. 8 reasons financial freedom takes longer than most people expect. From taxes and lifestyle inflation to family responsibilities, market volatility, and the slow early years of compounding. These hidden forces explain why patience and consistency are just as important as income. If you found this video helpful, don't forget to like, share, and subscribe for practical wealth building insights. Thanks for watching, and we'll see you in the next video.